Welcome to the Stock Market Palantir. Today we are going to talk about AMC.
A stock that, well, it really continues to define this era of finance. Here in late 2025, AMC Entertainment Holdings, Inc. stands less as a traditional movie theater chain and more as this unique intersection, a collision between really complex, distressed corporate finance and the sociological energy of the retail meme movement.
Precisely. And for institutional eyes, the focus is squarely on the capital structure. You're looking at the multi-billion-dollar debt pile, the maturity schedule, and just, urgent liability management. But for the dedicated retail base, the entire narrative is built around market structure failures and this pervasive belief in price suppression. So this radical divergence, it really frames the upcoming conflict over the December 10th shareholder vote.
That vote is arguably the most critical juncture since the 2023 reverse split. We're talking about Proposal 5, the request to increase the authorized shares from 550 million to 1.1 billion. So the question for us, I think, is whether this required financial engineering, which is anchored by that critical July 2025 Movico refinancing, represents a necessary, life-preserving strategy, or if it's actually a destructive, faith-breaking dilution spiral that's going to decimate the common shareholders.
My position is that dilution is a regrettable necessity, but it is paramount for survival. This vote is fundamentally about stability. It's about fixing a precarious capital structure and mitigating quantifiable bankruptcy risks tied specifically to the 2026 and 2029 debt maturity walls. The company is, for all practical purposes, in a survival scenario, and while painful action that ensures cash flow stability is required.
I come at it from a very different angle. While the financial metrics are severe, and I agree they are, we can't ignore that for the common shareholder, the path of dilution, especially after 2023, is seen as an absolute betrayal. They view Proposal 5 not as a survival mechanism, but as a sophisticated tool designed to bail out institutional bondholders while, systematically destroying the existing equity base. And frankly, this institutional perspective completely overlooks the profound systemic market structure issues that retail investors feel keep the price artificially low. It just makes dilution at these levels a moral hazard.
I do recognize the weight of that argument, especially regarding past trauma. But our focus has to remain on the balance sheet and the near-term risk. I see why you think that, but let me give you a different perspective. This vote is about solvency and bankruptcy risk mitigation, not speculation or emotional grievances. When we analyze AMC, we have to first view it as a capital structure problem. Its equity value today is best described as a highly leveraged survival option derivative. The 2025 liability management effort was successful. The Movico refinancing in July pushed billions in high-interest debt maturities out from 2026 to 2029 and 2030. That bought them time. But it wasn't free.
It certainly wasn't free.
The mechanism for that extension was the issuance of exchangeable notes. And crucially, that deal created an incentive structure tied directly to Proposal 5. If shareholders approve this authorization increase, the interest rate on those notes drops immediately. That saves AMC an incremental $35 million annually in cash interest payments. Given the company's continuing need to manage its negative free cash flow burn, which, even adjusting for non-cash items, was still around, $81 million in Q3 2025, that $35 million is vital. We are talking about critical runway extension here, not some abstract theory.
Okay, that's a very rigorous analysis of the debt service savings, I'll give you that. But it fundamentally ignores the emotional and the financial destruction that's already been inflicted. You mentioned the 2023 reverse split. That event, the 1-for-10, is the primary driver of the current vote no conviction. Retail holders universally call that period the robbery because the stock price just rapidly sold off post-split, leading to a near 90% loss for many long-term believers. That single event destroyed the foundation of trust between management and its primary funding source for the last 5 years.
But those actions, while painful, were fiscally motivated to deleverage the company.
They established a precedent of equity destruction. So the current vote no position stems directly from the fear that doubling the authorized share count to 1.1 billion is just the next stage of this pattern. Retail holders see this as giving management a 550 million share survival chest to be dumped into the market at $2.44, ensuring bondholders are covered while decimating the equity base yet again. Look, I'm sorry, but I just don't buy that. Let me tell you why. Granting management this massive share authorization removes the financial discipline needed to actually fix the underlying business. And that failure of discipline has been demonstrated by the continuous price collapse post-2023.
Okay, let's focus rigorously on the Proposal 5 math then. Let's weigh the true cost of denial against the cost of calculated dilution. If shareholders reject Proposal 5, the interest rate on those 2030 exchangeable notes stays high. The cash interest plus pie cash, or payment-in-kind interest, is fixed between 6 and 9%.
Can we just pause on that for a second? For the audience, when we refer to PIKE interest here, we mean the company can pay that portion of the interest not with cash, but by issuing more debt, or in this case, potentially more equity. It's how they defer a cash crunch.
Exactly. It's a method of conserving cash, but it still adds to the long-term liability burden. Rejecting Proposal 5 accelerates the cash burn by that $35 million annually. That's a significant, unnecessary strain when the company only has about $365.8 million in total cash reserves. Approval, on the other hand, triggers the possibility of those notes converting fully into equity, a process called equitization.
And equitization is the key word here.
It is. Equitization removes debt from the balance sheet entirely. It drastically improves leverage ratios, which is a key institutional metric for stability. The debt is just gone, replaced by equity. This is a crucial step towards long-term solvency.
And for the $35 million savings. But the cost I'm emphasizing is the complete loss of retail shareholder confidence. That's an intangible cost, but it is economically real. If the market anticipates management immediately selling a large tranche of those 550 million new shares, the stock price, currently hovering near its psychological $2 support, will almost certainly drop. This doesn't just hurt existing shareholders. It reinforces the retail belief that management is actively complicit in destroying their investment. You are trading a fixed, known cost of $35 million for a highly variable but potentially far larger cost in market cap and just the alienation of your entire shareholder base.
The priority for any distressed company, though, must be the financial health of the enterprise over shareholder sentiment. But okay, let's shift to your core critique of the market dynamics. You argue the low current price is a function of market failure, not fundamentals. How do you reconcile that view with, observable market data?
We have to focus on the institutional mechanics that retail believes are corrupting price discovery, specifically the persistence of FTDs, or fails to deliver.
Which are just unsettled trades, often due to operational issues.
Precisely, but they are interpreted by the retail base as clear evidence of illegal naked shorting, the creation of so-called synthetic shares intended to suppress the price. When you couple this with the persistently high off-exchange and dark pool volume ratios, often between 30 and 50%, retail sees clear evidence that true buying pressure is being hidden. So if the price of AMC is artificially suppressed, selling shares at $2.44 is, it's the textbook definition of shareholder value destruction. Why dilute at the bottom?
That's a compelling argument regarding FTDs. But have you considered that the low cost to borrow indicates liquidity is not constrained, which fatally undermines the core short squeeze thesis? The entire argument about suppression fundamentally rests on the idea of scarcity. The entire short squeeze thesis requires that the supply of shares available to short sellers is constrained and expensive.
No.
And it's the definitive signal. As of late November 2025, the borrow fee rate is extremely low. We're talking around 0.47 to 0.5%. This low cost implies that shares are abundant and, frankly, dirt cheap to borrow. This abundance directly undermines the retail scarcity thesis. The truth is, the primary compressor on the stock price is not some malicious suppression in dark pools. It's the $4 billion debt load and the massive dilution that has already occurred since 2021. The equity float is liquid and readily available, which is why the stock trades where it does.
But you're failing to distinguish between liquidity and natural supply. The abundance of shares and the cheap cost to borrow are direct consequences of management's own actions, specifically the dilution from 2023. Management has artificially increased the float, and in doing so, they've provided the ammunition for the short side to maintain pressure. It doesn't disprove the manipulation theory, it just proves management provided the supply to facilitate the price compression. So they are seen as complicit in undermining the very potential for a squeeze, which is why Proposal 5 is viewed not just as a bad financial decision, but as a deliberate hostile act.
Okay, but if we accept that the company needs to exist for any equity value to eventually materialize, then we must look at the operational fundamentals. If the debt can be stabilized by this Proposal 5 equitization, the underlying business is showing tangible resilience. We've seen smart strategic moves, like the foray into alternative content, modeled after the very successful Taylor Swift concert film. The financial data shows revenue per patron is strong, sitting at a record high of $12.25. Consumers are spending.
The concession strategy is strong, yes, I'll grant you that.
And the launch of the Popcorn Pass initiative, while it seems minor, is strategically sound. It's designed to drive repeat traffic to the concession stand, which is the high profit center. And crucially, the Q4 2025 box office slate, with major releases like Wicked and Moana 2, is predicted to be the highest in 6 years. If this fundamental floor materializes, it could eventually outweigh the short-term dilution trauma. This debt restructuring is just a corporate prerequisite to capitalize on a real operational turnaround.
Your operational analysis is entirely rational, but it assumes a rational, price-driven shareholder base. And I have to argue you're ignoring the anthropological state of the ape community in late 2025. The sentiment has pivoted entirely from the hopeful Lambo euphoria of 2021 to a deep, entrenched sense of vengeance and pure nihilism.
Nihilism? How does that manifest economically?
The prevailing mood is best summarized by their social media mantra. I am down 95%. I am not selling because the money is already gone. I am holding to see them bleed. Their investment is now a sunk cost, used as a weapon. They aren't motivated by profit potential in the short term, but by seeking retribution. And management continually reinforces this distrust. For instance, replacing the beloved physical refillable popcorn buckets with the digital popcorn pass. A small thing, but it alienated superfans who valued the collectible community aspect of the old system.
So even good operational decisions, if they're poorly communicated, just feed the skepticism.
Shattered in 2023 is repaired. Any positive fundamental shift, like a Q4 recovery, will be dismissed by large segments of the base as fake news. It's due to this pervasive shill-hunting echo chamber that exists on their social platforms. They believe the numbers are manipulated, the news is biased, and management is inherently untrustworthy. Therefore, fundamentals simply won't matter if shareholders believe the actual mechanism of value is controlled by hostile forces.
So the success of the business is contingent on shareholders trusting the mechanism by which they receive that value.
That is the core conflict. And the path of guaranteed dilution via Proposal 5 is perceived as the ultimate untrustworthy act, confirming their deepest fears of institutional collusion.
I think we both acknowledge that AMC is navigating a painful metamorphosis. It's transitioning from a pure volatility-driven meme stock to really a classic distressed turnaround play. And the key tension remains this December 10th vote. A yes mitigates bankruptcy risk and secures that critical $35 million annual cash saving, but it guarantees further equity dilution.
And a no preserves the current equity structure, honoring the retail base's stance against dilution, but it immediately increases the financial strain by $35 million a year. It significantly raises the measurable bankruptcy risk premium in the corporate debt markets, and that is the excruciating dilemma retail holders face.
I maintain that for the rational investor assessing corporate viability, the signal is no longer in the noise of social media or short-term FTD cycles. The signal is now firmly in the corporate bond market ratings and the actual operational performance, particularly the Q4 box office results. The financial survival strategy, though harsh, is the necessary and rational path forward to ensure the company exists long enough to benefit from any future recovery.
And I reiterate that without a substantial effort to address the systemic market structure concerns and, most critically, repair the fundamental distrust caused by the 2023 reverse split, any subsequent financial maneuver, no matter how rationally sound to a CFO, will be perceived by the retail base as a raid on shareholder capital. It just reinforces that entrenched, nihilistic, zero or hero mentality that defines this investment.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.